Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. You've probably heard of this before or said it yourself, that markets are going down like crazy, or my goodness, my portfolio is falling apart. Or as some of my friends in Hindi would say, gayi bhains pani mein, which I think should ideally be gayi bail pani mein. Anyways. Now, when we make these statements, we are usually reacting to something abnormal happening in the markets, even if we don't fully understand what that is. What we are really talking about is volatility. At its simplest, volatility is just this: how much the market is moving in a given period of time. Or to make it slightly more precise, how fast the market is moving right now relative to how it usually moves. This phenomenon called volatility is not new. It has been studied for well over a century. What's interesting is that volatility correlates with sentiment. Most of the time when volatility spikes, it's due to some sort of fear. As uncertainty rises, participants rush to exit positions aggressively. Prices begin to move more than usual, sometimes in ways that don't feel rational. But here's the important question. As a trader or an investor, how do you make sense of this? How do you move from reacting to volatility to actually understanding it, measuring it, and maybe even using it to your advantage? That's what this episode is all about. Expect this to be a multi-part series where we will attempt to holistically understand volatility across multiple periods for different investor and trader profiles. With that, let's get started. Before I even start talking about what volatility is, I would like you to look at this picture. I had shown this in episode 2 as well. Do watch it if you haven't. You see two investments. Both give you positive returns, but one is more painful than the other. As you can see, it is not about the direction or the extent of the move. It is about how price behaves as it moves. That's what volatility is in its simplest sense. On any given time frame, and this time frame or time anchor that we are talking about is very important, how the price moves or varies is what volatility tries to measure. So you can have two indexes. Let's say both give you a 10% return at the end of the year. One gets there with sharp swings, constant up and down, while the other moves in a much smoother, more stable manner. Even though the returns are identical, the experience and the risk is completely different. And this is exactly where the idea of risk-adjusted returns comes in. We've referred to Harry Markowitz in episode 11, the man who came up with the idea of measuring risk with respect to return and not just returns. The risk which he was referring to was nothing but the variance or volatility of those returns. He single-handedly moved the conversation from picking good stocks to building an efficient, diversified portfolio. That shift from returns alone to returns relative to risk is what laid the foundation for modern portfolio theory, the key insight of which is to diversify across assets to reduce variance or volatility of the portfolio. Back to basics, but how is volatility measured for an individual asset? Let's say Nifty 50 for instance. Fair warning, this can get a little nuanced and complex, so you may have to pay extra attention. When we talk about measuring volatility, there are two fundamental aspects to it. One is the time anchor or time frame, which means when you are looking at volatility, at what time frame are you looking at? For instance, you may be looking at close to close prices, which means you take close price of each day and try to measure the volatility between them, which would be different from, let's say, intraday volatility, which we'll get to later. Then comes the look back, which means how far in past are you looking to calculate the volatility? Are you looking at the past 30 days volatility versus the past 1 year volatility? Because volatility is cyclical and there would be phases of greater volatility and phases of calm. Lookback is an important criteria. So typically we would want to compare, let's say, a 20 or 21 day volatility with that of the whole year to 52-day vol. Now, the obvious question is, what does this 28.56% mean? It means over the last 21 days, Nifty has been moving at a pace that, if it kept up for the full year, would imply a 28.56% swing in either direction. This number, 28.56, is calculated using a three-step approach, which includes 1. Calculating daily log returns, 2. Calculating the standard deviation over n number of days, and finally annualizing it to make it comparable. There is a Varsity link which explains this, and the link is in the show notes. So what we just did was calculate annualized volatility with a fixed lookback. Ideally speaking, it's better to calculate volatility with a rolling lookback. What that means is every day we look at the past 21 days, the past 63 days, and the past 252 days worth of volatility and calculate it. That gives us a better sense of how volatility is evolving across different lookbacks. As you can see, the shorter the period, the higher the volatility. And that's obvious. It also tells us that in the short term, the volatility may spike, but in the longer run, it kind of reverts to the mean. This is visible when you see the orange line, which is the 21-day volatility, moving away from the blue line and then usually coming closer to the blue line, demonstrating its mean reverting tendency. The fixed calculation is fine for a one-time answer to how volatile has Nifty been recently. The rolling calculation is what you need if you want to understand how volatility behaves, changes, and signals things over time. That brings us to the next question. So far, what we understood is what is volatility and how do we measure it. Now let's move forward. Let's try to understand the relationship between volatility and direction. That means, does volatility increase when the market goes down? On a side but related note, Fisher-Black, yes, the same Fisher-Black who contributed to the Black-Scholes model, tested something called the leverage effect. He was looking at data of stocks, and what he observed was that stocks show higher volatility when falling. He explained that the leverage effect functions as a psychological and financial feedback loop that explains why market downturns are much more violent than rallies. He said it begins the moment a stock price starts falling. And since a company's debt remains fixed while its equity value shrinks, the firm's financial structure becomes top-heavy, effectively increasing its financial leverage. This shift makes investors increasingly nervous as the protective buffer of equity diminishes, leading to heightened sensitivity and erratic trading behavior. Ultimately, this collective anxiety manifests as crazy price swings, causing volatility to spike in direct response to the declining price, creating a self-reinforcing, vicious cycle of fear and uncertainty. Now that's how it plays out in reality as well. Anyways, back to Nifty 50 and our analysis to test the relationship between Nifty's volatility and its direction. So to test this, I created a simple hypothesis. I wanted to answer the question, does Nifty become more volatile when it is falling badly compared to when it is near its all-time highs? But how do we quantitatively define falling badly versus near its all-time high? Because to test it, we would have to define it. Now, falling badly was something which I defined as 10% below its all-time high. And near all-time high means within 5% of all-time highs. That's how we define these two states. The next question is, how do we measure it? What we do is we calculate a rolling 21-day volatility and then look at that number every time when Nifty had fallen more than 10% from its peak versus the days when it was closer to 5% from the peak. Now, on this image, what we have is Nifty 50 close price over the past 10 years, and below that, we have a 21-day rolling volatility. As you can see, every time you see a red section at the top, which is where Nifty has fallen 10% below its all-time high, you have a spike in volatility. That is very evident, and that's still going on as we speak. And for the quant nerds, we have a box plot to the lower left. The two boxes don't overlap at all. That alone tells you the difference between regimes is real and large. The line inside the box is the median. The stress median is around 18% and the calm median is around 10%. On the right, we have the volatility distribution overlap shown on a histogram. The green hump on the left is calm days. Almost all of them cluster tightly between 5% and 15% volatility. It's a tall, narrow hump, meaning calm days are consistently calm, not much of a variation. The red spread on the right is stressful days. It's flatter and much more spread out if you see, stretching all the way to 90%. That flatness tells you stress volatility is unpredictable. Sometimes it's moderate, sometimes it's extreme. The dashed lines are the averages. The green around 11%, orange around 24%. Again, the two distributions barely overlap each other, meaning they are distinct regimes. In other words, on days when Nifty was near its all-time high, the volatility averaged about 11%. On days when Nifty had fallen more than 10% from its peak, volatility averaged at 24%. That's more than double. Over the last 10 years, every time Nifty fell 10% or more from its peak, the market was moving at roughly double the speed compared to when things were near all-time highs. During calm periods, Nifty moved just about 11% a year in annualized terms. But during bad periods, that jumped to nearly 24%. And during the worst possible COVID drawdown, it hit 90%. There are 32 distinct stress episodes in 10 years. Some lasted a single day, brief dips that recovered fast. The big ones were COVID March, July 2020, 97 days, average vol 42%, max drawdown 38%, 2022 bear market, multiple episodes through May all the way through July, drawdown hitting 17%, 2025 recent episodes still playing out currently, and it's in the stress territory. So finally, now we know why they say markets go up through stairs and come down through the elevator. Data supports it too. So that brings us to the end of this episode. We started with the basics, understanding that volatility is not about direction, but about how prices move. We looked at how it's measured, how it evolves over time, and how it behaves very differently in calm markets versus stressful markets. If there's one thing to take away, it's this. As Taleb puts it, volatility is information. It is left to us as to how we understand it and use it to our advantage. In the coming episode, we'll take this thread forward. We'll look at volatility across different time frames, understand how it feeds into option pricing and how it gets measured as implied volatility, and most importantly, whether there is a way to actually use that information to structure our trades. With that, I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.